Welcome to the Risk Manager's Corner. In this episode, we unpack Pillar 1 of Basel II, where the global regulatory framework defines how much capital banks must hold for credit risk, market risk, and operational risk. If you're in financial risk, compliance, treasury, or internal audit, this is your strategic guide to understanding the numbers behind solvency. Let's get started. What is regulatory capital? Regulatory capital is the buffer banks are required to maintain to absorb unexpected losses and continue operating in times of stress. It's a legal requirement. It protects depositors, counterparties, and the broader financial system from collapse. Basel II introduced a three-pillar framework. Pillar 1. Minimum capital requirements. Pillar 2. Supervisory review. Pillar 3. Market discipline through disclosure. This video focuses on Pillar 1, the quantitative foundation of the framework, the Capital Adequacy Ratio. At its core, Pillar 1 defines a Capital Adequacy Ratio, or CR, requiring banks to hold capital equal to at least 8% of their risk-weighted assets. This capital is divided into Tier 1 capital, core capital like equity and retained earnings, Tier 2 capital, supplementary capital, like subordinated debt and hybrid instruments. At least half of this capital must be Tier 1, ensuring the majority is permanent and truly loss-absorbing. Credit risk. Capital requirement. Credit risk, the risk of borrower default, is typically the largest component. Banks have three approaches to calculate it. Standardized approach assigns fixed risk weights based on external credit ratings. A highly rated corporate exposure carries a lower risk weight than an unrated or lower rated one. Mortgages and retail loans get special treatment with reduced weights. Foundation IRB approach. The bank estimates the probability of default. Other components like loss given default are provided by the regulator. Advanced IRB approach. The bank estimates all core inputs based on internal models. This approach is more risk-sensitive, but also more demanding in terms of data, systems, and governance. Under the IRB approaches, capital is linked to probability of default, exposure size, and potential loss, calculated at extremely high confidence levels to withstand severe stress. Market risk. Capital requirement. Market risk covers potential losses from fluctuations in interest rates, exchange rates, equities, and commodities. There are two approaches. Standardized. Regulators prescribe fixed charges for different instruments and sensitivities. Internal models approach. Banks use value-at-risk models, approved by regulators, to calculate potential losses based on historical data and assumptions. These models must be backtested regularly. If they fail validation, penalties are applied, such as higher capital multipliers or model rejection. This encourages robust risk modeling and strong internal governance. Operational risk capital requirement. Operational risk includes losses from system failures, internal fraud, legal issues, or external disruptions. Basel II offered three methods to capture this. Basic indicator approach. A simple formula applying a fixed percentage to average gross income over 3 years. Standardized approach. Breaks down income by business line and applies specific risk multipliers. Advanced measurement approach. Banks build internal models using internal loss data, external event databases, scenario analysis, and control environment indicators. This reflects the maturity of the bank's operational risk framework. The more advanced the method, the more risk-sensitive, but also more demanding to maintain. Total capital requirement. Once each capital charge is calculated, for credit, market, and operational risk, they're summed up. The bank's total eligible capital must be sufficient to cover the total requirement. In practice, well-capitalized banks aim for a buffer above 8% to remain compliant during stress and meet expectations from Pillar 2 and market stakeholders. Target capital ratios typically range from 10 to 14%, depending on the jurisdiction and the bank's risk appetite. Limitations and criticism. While Basel II brought major improvements in risk sensitivity, it also introduced new challenges. Capital levels tend to fluctuate with economic cycles, making them procyclical. Internal models can be gamed or manipulated if not properly validated. Complexity and data demands can overwhelm smaller institutions. And most notably, Basel II underestimated systemic risk, especially interconnected exposures and liquidity shocks. These limitations laid the groundwork for Basel III. Role of the risk manager. For risk managers, understanding how capital is calculated is only the beginning. You must validate inputs like probability of default and exposure assumptions. Monitor capital usage and trends across the risk types. Collaborate on stress testing, ICAAP, and recovery planning. Translate capital impacts into business terms senior management can act on. Capital is not just a number, it's a constraint, a cost, and a strategic asset. Managing it well creates value and resilience. Final takeaway. Basel II. Pillar 1 embedded risk sensitivity into the regulatory capital framework. It's technical, data-driven, and central to modern banking risk. If you want to influence capital strategy or protect your institution from undercapitalization, you need to master it. Subscribe, stay sharp, and own your risk.